All right, hello everyone. We are South Dakota State University, the CFA Research Challenge Team. My name is Andrew Clay.
And my name is Jie Hu.
I'm Anthony Bakkedahl.
And I'm Trevor Kuechenmeister.
So a little bit about the business. It was founded in 1949 in Minnesota. Currently, the company has over 7,000 employees, and the business competes in 4 different market segments: the framing systems, glass, services, and the large-scale optical technologies. This is a little breakdown of the revenues. We can see that the systems are 49%, glass is 25%, service is 20%, and the large-scale optical revenue is 6%. A little bit more about the framing systems. Apogee has acquired many different companies throughout the years. So with that, the framing systems has 6 major sub-companies: Alumicor, Sotawall. All of them help with the windows, the entrances, and the curtain wall systems. The picture seen is the BMW headquarters in Canada, and that was worked on by Alumicor. The glass, the services, and the large-scale optical. Like I said before, Apogee has made several different acquisitions. In the glass section, Virecon's a big one, and the service Harman, and then the LSO is Truvu. The picture there is part of the MGM complex in Las Vegas, and it was worked on by Virecon.
For the growth drivers and competitive positioning, the biggest growth driver for Apogee would be acquisitions, with their latest acquisition of FCO in 2017. For domestic outlook, the U.S. GDP has decreased by 0.3%, and the U.S. has placed a 7% tariff on all exported goods. An economic and industry overview, the U.S. economy is expected to show a rebound after COVID. And business scale, Apogee has 21 manufacturing locations across North and South America. Here's just a little graph of their competitors. 2 private companies, Triumph CNA and Technoglass. And then there was a publicly traded company named Saint, but that was more of an outlier than comparison. And if you look at the revenue breakdown, Apogee doubles and almost triples their revenues.
There are 3 growth drivers. The first growth driver we think is acquisition, and Apogee, this growth slows down since its last acquisition in 2017. As we know, Apogee does not have any acquisition plan for the following several years. And the second growth driver we think is diversification. Apogee expands its market to Canada and Brazil, but the main market stays in the US. And also in past 10 years, Apogee increases the proportion of architectural framing systems and relies less on the glass segment to make the business more stable. And recently, Apogee expands its business to small and middle-sized projects. And also it starts the retrofit and renovation business. We think these are potential growth opportunities in the future. The third growth driver we think is cost reduction. Apogee realizes the permanent cost reduction through the procurement initiatives and operational improvements. And also Apogee achieved some temporary cost reduction in response to the COVID-19.
Here's a look at past performance of Apogee, and the other 2 lines are the Russell 5000 and the S&P 500 index. And if you look at this graph, we found some interesting conclusions from 2015 to 2018 about Apogee, and we'll talk later about that in slides to come. Here's our financial analysis breakdown. Here's 5 years of earnings from it. Apogee has a 1.7% dividend yield, and the industry average for basic materials is 4.92. And that, I'll end with that one. And Apogee has been paying out 28% of its dividends every year, and it's known as a dividend company as we know. Here's a financial analysis of revenue by each section breaking down, each segment broken down. And the past 10 years, we've had pretty consistent growth, but in the last 10 quarters, COVID directly impacted Apache's business because of its issues of debt, which we'll talk in a couple slides. And here's basically their profit, 10-year profit. You know, it's pretty consistent. It's not growing too much, but it's not going downhill. And in the last 10 quarters, COVID has struck in the market for glass manufacturing business. And here's a financial analysis. Apache's running a negative equity, and for a glass company, this is questionable, but it will build itself out because it has a sustainable competitive advantage. But its debt and bonds that it has issued in the last couple months and years is a significant issue in my opinion.
We applied for 4 different valuation models to conduct the absolute valuation, and we use the average performance of past 5 years as our reference. We use this as our benchmark because we think 5 years is a business cycle for Apogee. It includes both high growth period and a low growth period. The valuation results range from $25 to $37. We think the current price of $38 is overvalued according to this valuation result.
Next part is the investment risks, litigation, COVID, and raw materials. Apogee is a construction company, so there's always going to be different litigation disputes. Those could be payments for damages and replacements, different types of general liability. As far as COVID, order times could have been delayed, products might be unavailable. It's definitely affected different business activities. And then raw materials, most of them are domestic and from international sources, and Apogee hasn't really had a problem obtaining those sources. The trademarks, patents, and environment. Apogee possesses several different trademarks. The problem with trademarks is that they go bad every 10 years and you have to renew them. One problem that could arise is not being able to renew that trademark. And so that's something that from an investment side, you always have to be aware of. And then like most companies, Apogee does use hazardous materials in their operations. But they do hire out third parties to help dispose of the waste, and that helps Apogee stay in compliance with the different laws and regulations in the U.S.
And here's just a government's breakdown of Apache's executives. And if we look, they're paid pretty well, and they're paid in cash as like a payment every month or every paycheck, and they're paid in stock options. And something interesting that I found as looking online is that Apache's executives have been acting on warrants at $8 to $25, and the next day they're selling those exact shares that they acted on for $45 to $50 to $60 a share. And this is telling me as an investor of what's going on in here, that the executives are selling at 60 and now the shares were 38. And I mean, it's kind of an interesting idea.
And then the investment summary. The current price of Apogee is $38.21. Our recommendation for the investor is to sell at a 1-year target price of $28.65. We believe this because of many different reasons. 1, it doesn't have a strong potential growth driver. 2, because of the executives selling. And then 3, because of our valuation conclusion. For our valuation, we use the dividend discount or the discount cash flow model, as well as the discount dividend model. And that's the end of our presentation.
Go back to screen share, just and then show our faces.
Okay, we will start the Q&A period here in just a moment. Judges, may I remind you to unmute your microphones as you ask your questions.
Hey, thanks for the presentation. Nice job. This is Jake Seltz. And I was curious if you could share how the pandemic has altered any of the structural growth drivers for the company.
I believe that growth has been stricken because of the inability to go outside in Minneapolis and around, and other big country or big places. Everything stopped. People don't go outside. So if business has stopped, that means that other than grocery stores, it's kind of a tough market to be building a house in. If the people that they're selling the business or selling their products to isn't doing business.
Did you guys look at, it seems like a lot of their strategies built around M&A. Did you do any sort of M&A return calculation like ROIC or like, are they a good acquirer? And do you think that's a good strategy for them?
I think that they have been acquiring good businesses, and they're running a return of equity of around like 8%. And at South Dakota State, we like to find a return of equity around 15%, and 8 isn't up to par for South Dakota State.
Hey, it's Kerry Robinson from Macquarie. I have a question about the valuation. You had a pretty good detailed analysis of how you came up with your price target at $28. And I was wondering if you could detail out some of the, I was intrigued by the NYU model that you used. What is the various growth segmentation metrics that you used in that model or one of the other ones?
Sorry, which model did you see?
Well, so the two that stood out that you used in the conclusion was $28 price target. And so I was curious what the growth assumption was in either the DCF model or the NYU multi-stage DCF model. What the growth assumption was, the discount rate, kind of any metrics you could share on how you came up with the price target.
Yep. The growth rate assumption is that we get the average growth rate of past 5 years and did some modification to make it slightly lower than the past 5-year average, but is greater than the past 3 years average. Because we think before 2017, there is FG is in high growth period, but we think in the following few years, it will not come back to better than the years before 2017, but it will be better than past 3 years. So we kindly make our assumptions better than the average of past 3 years, but lower than the average of past 5 years. That's our growth rate assumption.
Wonderful. Thank you.
I'd like to ask 2 questions, unrelated, but the first is if you could advise management as to how they should deploy their capital, their cash flow, what recommendation would you make to them?
I feel like as an executive manager, you're a direct representative of your company. So if you're selling shares, I think you should tell all your shareholders. I mean, it's hypothetical, but you are the face of this company if you're the CEO. And why? I think you got to let everyone know that there could be some dangers that as an owner, it would sound different, but the owner hired people to directly represent a company. And that, I think, is weird that they're selling shares or taking warrants of $8 to $15 a share and selling it for $55 a share to the public. And the executives are cashing in, not the public, not its investors, the executives.
Okay. So my other question has to do with ESG. How is this company positioning themselves to investors who are concerned about environmental, social justice, and governance issues?
There's a guideline of between 0 and 100, I want to say, of like the ranking that companies, like construction companies who use waste, have to follow. And Apogee is right in the middle. It's not following rules, but it's right in compliance with the industry average. And I see in the future that other than the government, or not the government, the executives like acting on warrants and selling it for way higher to the public, the business isn't going to have any issues with, like, they're not putting bad water into the ground, or they're not putting lead in wherever they're mining to where they're getting the glass from. It's pretty straightforward, and they're complying with the government.
Can I ask another one on, you brought up management compensation and that the CEO and the company's been selling a lot of shares. I guess, did you look at the proxy and did you figure out how they're compensated? I know they have a salary, but are there metrics? Are they paid on cash flow? Are they paid on margin expansion? Like, how do they get their options every year? Because given the performance of the stock, right, you'd think they would be getting those warrants that they keep selling.
I don't know for sure, but from my research, they're given a payment, like as if you work for a general store, you work and you get a payment for the hours you put in. Probably won't get paid by the hours, you get paid by the quarter, or by the every 2 weeks. And then every year, I believe they're given options.
Okay.
Hi. So my second question is, as analysts, we rely on what management has to say, but at the same time, we look for kind of outside sources to help us shape and form our estimates. So can you discuss any non-management or non-Wall Street resources that you used in your analysis, and how were they helpful?
So I believe that most of our most of our information came from Bloomberg, Yahoo Finance, and their annual report. I found out a lot about their company and reading its annual report over and over, just to kind of feel like to get a handle on what they do. And you're right. The Wall Street point, like, if I own this company, it'd be different. That I wouldn't necessarily want to sell my shares. I'd want to hold on to them and hopefully they go up. But as students, we just kind of take it for, if we had this money and if we had $50,000, would we want to invest it into Apogee? And at South Dakota State, we'd say no. We'd pick Pepsi Cola or something where we can get $5 a share. We can get a snowball that we can push down the hill, instead of with Apogee where we have to push the snowball up the hill because of how much debt they've acquired and how many bonds they've issued.
Hey, it's Kerry. I got a question about the financials. I'm intrigued by you recommending shorting the stock, and I'm wondering, are you seeing some deterioration in some of their metrics in the financials, whether it be operating margin contraction or revenue growth degradation? Is there something in the financial analysis metrics that would be a catalyst for the stock to move to your price target?
50 seconds left.
Okay. So with Apogee, I don't believe that their business is harmed at all right now. They have a good business, but to have a good business and then to issue $800 million in bonds, and to issue $300 million in debt, that affects your business. You have a good business, but then you throw this in there. Well, that's part of your business now. So now we have a great business. It's kind of like Kraft Heinz. Lots of debt, but good business. So 5 to 10 year target is okay, or is going to be paying off debt. But in the next 50 years, it could be a good business because it does create profits for its shareholder. It has wealth creation.
That's the time. Thanks, guys.